Hello everyone, it be the Borg, and today I'm giving you guys a little video on leverage. Leverage is something that I think a lot of people starting out in Forex trading really don't understand because it's not really something that comes into play in a lot of different fields, at least at the basic kind of levels. So you can get it with a pretty quick Google search, but I'm going to give you guys this video on it. So here we are on our Trader's Way demo account today. And I'm going to show you all about how leverage works, what you want to be risking, what you don't want to be risking, and kind of the rules of the road of it. So let's get down to the basic idea. Leverage is a way that you can make more money or lose more money on trade. So if you say, basically, if you're trying to understand what Forex is in the first place, it's foreign exchange. So you're exchanging large amounts of currency for another large amount of currency, and you're looking to make money off the small changes. So here we are on the Great British Pound. The price currently today is 1.2936, and you'll recognize this 36 as the pip number. So here's your pip is the 6, it's the fourth digit, and here the 3 is the, anyway, it's pretty basic stuff there, guys. But what you're looking to do, and why pips are so important, is because every little change can be a dollar value. So if you had, say, if you have one lot, which is the minimum size of a currency, that is 1,000 units of that currency. So if you have, let's say, 1,000 units, and you're trading, let's say, the GU here, 1,000 currency units would be 0.01 there. So that would be the amount you are, trading. That is 1,000 lots of currency. So by putting $1,000 on a trade, which would be one-to-one leverage, you would be, basically at your margin if you had a $1,000 account, and yeah, and you'd only be able to make 10 cents a pip. But what brokers do is they allow you to leverage up or to take more risk and more reward. So here's a basic, I'm going to give you a little sheet on a second on how to do leverage, but here's the reason you don't want to mess up your leverage. Here is a $566 account, and this is 4.01. Okay, this amount is equal to $40 a pip, so it's slightly less than 10% a pip. So we're now going to decide to take the GU down. So when you see this nice red number, this red color on your MT4 platform, you know that you're kind of in trouble because your margin is being, pushed. So, yeah, your margin is really being pushed, and this is what you want to avoid because we're already down, $79, and we just placed the trade in the first place. So this may work for 3 pips up or 3 pips down. That's what I have the take profit stop loss set up for this example. But anyway, we're going to let this run in the background, see how it turns out. So you don't want this kind of thing going crazy like that. So I made you guys a little sheet on it. In terms of, is leverage good, is it bad? Leverage is freedom. So freedom is usually considered to be very good, particularly under the ideas of Western society, because that's a lot of what it is about. So leverage is a type of freedom. Freedom is good. But freedom has its upsides and freedom has its downsides. So you really need to know what you're doing to make it work out. And I also think this third part is very important, that you want to only risk what you are willing to lose. Okay, so if you have a $1,000 account and you're only comfortable with losing $20 of it, or 2%, then don't risk more than that, because if you do, you're going to affect your subconscious mind to be panicked and bung-holing, and you're going to be all like, oh no, is it going to win, is it going to lose? And you'd even get out of winning trades because you're so scared they're going to go for more against you, or they're going to lose, or there's going to be a problem. So that's something that really trading in the zone really hits on. And so leverage is the same way. You don't want to risk a lot more than you're willing to, but you don't have to adjust your leverage in order to do that. You just have to trade inside your risk parameters, which I'll give you guys in a second here. So anyway, I also want to push the point that every trade has a random outcome. Now this basically just means that you can't expect to win. You can't expect to I said that wrong. You cannot expect to win every trade as a newbie at the very least. Now I know BR and Anissa and Kevin and Jazz Fran win something like 99%, okay? Which is a very, very large percentage, It's pretty much unheard of in the trading world that, you can be able to pull that off. But here we have a tool to do that. Still, I don't think that aiming at perfection is ever a good idea when it comes to this, because in order to succeed, you really have to know that trading can have a random outcome, that some things can just happen at any time. Traders can jump in the market, jump out of the market, news can hit, this can happen, that can happen, and everything can kind of go crazy. So you really need to accept that, there can be a random outcome. So you need to, like, of course we have an edge in the market that's massively pushed in our favor. So, if you have a 90% edge, 9 out of 10 times you're going to win. But that other time, you can lose. So don't put your entire farm on one trade, Anyway, so let's get down to the other stuff. First off, our trade lost here. So we went from a balance of 566 down to 415. So if you were on a winning streak and you built this account up from say $100 and you were like, yeah, I'm gonna win, and poof, in a flash second, because you're using such a high leverage, you can get burned really, really badly. So I want to make sure that never has to happen to people. So anyway, I already explained the basics here. Here are the pip values. So if you had a $1,000 account, then 1 to 1 means you can trade up to 10 cents. 1 to 30, you can trade up to $3. You can trade up to 10. You can trade up to 100. Kind of on this thing. And really, this is kind of an important thing, because I think that if you have a $1,000 account, you should definitely not be trading more than 1% of pip. Now, I know it looks tempting, particularly if you're like on 10 pips. I could make, I could trade 2.5% of my account on a pip, and I could make a ton of money doing that. I can make 25% a day on 10 pips. But you can also lose that very quickly, and if slippage kicks in, you're pretty much dead. So you can lose everything on that kind of thing. So you really need to have a better kind of risk management, I think. But if you can do it, then by all means, go ahead and do it. I'm just telling you a little bit about my experience and other people's experience on that kind of thing. So there are the basics there. You can pause and look at this. I kind of just wrote it out really quickly. But one of the most important things is this next paragraph, which talks about how you're really dividing up your account. The way Pinky kind of explained it to me, and I was first hearing about risk management, going back to Ghost and Amo talking about it, and all these kind of people really covering it very well. If you take your account and you divide it into thousandth, so if you have thousandth, if you had, say, $1,000 in your account, then you would divide that into 1,000, which is equal to $1. If you had $415 in your account, you would divide that down to 41.5 cents. Now, the reason that number is important is because this is your standard starting amount per pip, in my opinion. I think this is the best way to do it once you have a pretty standard way of trading that's actually succeeding, not if you're like just throwing money around or doing whatever, just trying to first find your edge, and doing 10 cents a pip is better there. But here we are. So if you have $1,000 in your account, you're pretty consistent already, and you're ready to start trading real money or do more real money. What you do is you say, okay, 1/1000th of my account is what I'm willing to risk on the pip. So I use a pretty standard 20 stop loss. Other people use 15 or 10 is becoming very common these days. But let's say it's 20. So, if you have a 20 stop loss and you're risking $1 a pip, you're risking $20 out of your $1,000 account. So that's 2% risk on one trade. And, you can easily make this more. So if you were risking, say up to $3 a pip, that would be $60 or 6% on the account. And you can easily, like destroy yourself doing this, because you could trade on 1,000 leverage pretty much up to like 90, 80, 90, depending on what your margin is, because of the stop out level. Basically, you could trade that amount per pip. So if you had $1,000, you could trade like $90 a pip, and boom, you could wipe yourself out pretty quickly. So this is a lot safer to do this kind of thing. So here are a little bit about rules for your common hedge fund that they use for managing their money. So what safe kind of funds do, and often like pension funds and other groups decide to do if they're a little bit more into trading some interesting equities, what they want to do is they never want to risk more than 1% on a trade. And they also want to never risk more than 5% of the total portfolio, at least per, trader and such. If you're a little bit riskier as a fund, you could trade up to 5% a trade and never risk more than 20% of the capital, just because you know that anything could happen at any time, as trading in the zone teaches us about this. So for us, I think since we're smaller in terms of things, I think that what you'd want to do is you'd want to risk between 1 to 10% on each trade, and I'd say somewhere around 20 to 30% being your maximum risk on the account. Now I'm a little bit riskier, and I know what I'm doing there in terms of doing that kind of stuff. But if you're starting out, of course, and you're starting to get consistent, I'd say only 1 to 2%, something like that. Here are my recommendation levels. I think like Falcon shot a video that's on MT's channel that talks about this one. But if you had 1.5% on a trade, that's the max you're going to lose. And this is for a day you're not feeling too great, but you still have your setup and you know what you're doing. A standard 3% is pretty solid on one trade. 4.5 would be a little bit more. I personally do 6% on a trade just because my accuracy is high enough that it makes it possible. 8% I think is what people like Pinky and those kind of people do, because if you stack a trade 4 times and you take your account divided by 1,000. Anyway, I don't want to have to walk you guys through the math because I know that Anissa and others really hate math, but basically you end up doing about 8% a trade, now counting commission and spread and things like that. But yeah, that's kind of the basics of how leverage works and how you don't want to end up going from 566 down to 415 just on a little 3-pip move because you decided to risk $40 a pip. So yeah, anyway, here are your good numbers if you want to risk on a total trade, because the leverage is not particularly important as long as it allows you to risk up to this percent. And you don't want to risk a huge part of your account, like 50% or anything crazy like that. You don't want to have to do that. So I think it's better if you risk something like 1 to 10% of the account when you're really starting out, or 1 to 10% per trade, and up to 20 to 30% of the account, because when you got a small account, if you need to make better gains, you do need to risk some, because risk and reward go hand in hand. You just don't want to go off the deep end on this one because it can destroy you. And I also wanted to touch a little bit on our recent stuff we've been talking about a lot, about how our goal is not to be rich here in a week. Like MT is going to be around a long, long time. He's constantly talking about all this stuff about health and things like that. And, he's a pretty healthy guy, and he's, super happy and things like that. So he's going to be around a long, long time, and he's going to keep this room around for us a long, long time, because this is just such an amazing place and all that kind of stuff. So we have time here, guys. Like when most people look to build their fortune, they don't do it in a day, in a week, and even a year. It takes a lot of people, 10 years or so to make their first million. But here, I think a goal of 1 year or so is the proper way to shoot for. And if you start getting past that, you can do it even faster and faster and faster. And that's kind of it's kind of a pretty awesome part of this room that you can really do that. So next up, I am going to give you guys a video soon, either this week or next week, on a strategy I use to first become successful that has only 3 steps in it. It's pretty not complicated. It uses Jazz Fran's 1 and 4 hour stuff. And it's just trying to get more people into mechanical trading, because when it comes down to it, you really want to keep emotion out of your trading, because a lot of people are very emotional. They want to be perfect at their trading, and it's a pretty easy trap to fall into just because of how we're taught, at home, at school, at all those kind of places. So until that kind of reform happens, most people are going to have problems with their trading mindset. And so I think mechanical trading is really the first step, as Trading in the Zone talks about it. So that's a little peek for next time on a bit about that. But really, here's a little bit of math on compounding. If you take $1,000, you make 4% a day, you compound this for 200 days, which is most of a year, up to about next May, according to The Rock or so, then you end up at about 2.5 million bucks. So most people, if you're starting out with $1,000, are, pretty astounded to be able to make that kind of return, and in this room this is fully possible. Now you can go off the deep end, and that is really the worry. If you think that you can make 25% on the day, or you think you need to do that or something like that, but everybody who's really made it far in this room has started small. They've started at a level, maybe they've made some mistakes, they've done this, they've done that, but they've started at a level where they would take only a few trades a day, and they got really good, and they got to kind of a mechanical trading point before, the other levels of trading that Trading in the Zone really discuss as well, about how you get to an intuition kind of stage where you can really see the trades before they're coming. But anyway, I'm kind of babbling on about that a little too much. Here's leverage, here's how it basically works in terms of what to do, and I think that leverage is not particularly important as long as you have enough. If you have too little, you're going to want to make sure that you can meet your risk parameters. And I think if you're a newbie, risking up to 10% of your account at one time is an okay kind of thing to do. Not necessarily on one trade, though. So I think that starting out with a standard of 3% on a trade is a pretty good idea. If you have even risk to reward, you can make 1%. I mean, you can make, 3% on that kind of trade. So if your system is really good, you can make a couple percent a week. And if you only have a $100 account, you might only be able to make a couple bucks, and you feel like, dang, I'm a failure. I'm not making $1 million yet. But really, once you have a point of consistency, nothing can stop you. Basically, you get more consistent, you feel better, you can add more money, you can even start making larger and larger percentages, and you can up your risk. I really recommend you don't start at 1% a pip where you're risking like 20% of your account or 10% of your account all in one trade. Now, if you really know what you're doing, by all means do that. But if you don't, I think it's a good idea to start at a safe place with live money so that you can start making it. And once you feel consistent, once you start to get it after 3 or 4 weeks of just consistently making money at the end of each week, just add more money and really get to, growing it that way. Because your standard funds, that's the best, like the best hedge funds in the world, produce, like, a good hedge fund produces something like 17% on the year. A great hedge fund, 30% on the year. We can do that in a week easy. If you're even like a fifth as good as that, you can outperform the best hedge funds in the world right here pretty easily. So I'm going to give you guys a little more on that in the future, but here's leverage, here's how it works, and don't make a mistake like I showed in this account, because that's not good. So thank you all for watching, and this has been the Borg MT, and I am out of here.